There is a signal that appears only for a few seconds right before the whales distribute. It isn't loud, it doesn't explode, it's almost invisible. But to a professional trader, one glance is enough to know what's coming. The market is about to turn red. What's frightening is that more than 90% of traders never even notice that this signal exists. In financial markets, large money never acts the way you expect. They don't sell when everyone can clearly see selling. They exit precisely at the moment when the crowd is convinced the trend has just been confirmed. And this truth is something very few people ever hear, because those who control the game never want you to understand it. Have you seen this before? Price moves up cleanly. The community starts shouting, "Breakout." The chart looks flawless. Nothing seems suspicious. You enter a trade. Not long after, the market reverses and drops straight down. You don't understand what just happened, but large money does. The problem isn't that you traded poorly, it's that you didn't see the exit signal that appeared beforehand. And you're not alone. Almost every trader has been caught in at least one move like this. That's also why most traders are eventually eliminated from the market. Only a very small group stays long enough to realize an uncomfortable truth. Whales always leave traces. They're not visible on the surface, but if you know how to read them, you'll never be ambushed again. In this video, I'll point out the signs that whales always leave behind before the market turns. And at the end, I'll share one single signal, very subtle but extremely powerful. When you see it appear, the smartest thing you can do is stay out. Just understanding this alone can help you avoid most of the crashes others still call unexpected. But to understand why most traders never see this signal, we have to return to something very basic. They're looking at the wrong thing. Retail traders look at price. Whales look at the flow underneath. Price going up doesn't mean money is flowing in. Price going down doesn't mean panic selling. Those are just what the surface wants you to believe. Retail traders watch green and red candles. Whales watch liquidity. They observe who is trapped, who is euphoric, who is starting to panic, and who is about to become the next source of liquidity. That difference in perspective splits the market into two worlds. One side reacts after the market has already moved. The other side forces the market to react to them. If you only watch price, you're looking at exactly what the whales want you to see. But when you start watching the flow of money and the behavior behind price, you're touching something they never want to be seen. And that's why the probability of getting trapped in this market is so high, it's almost unavoidable. More than 95% of traders buy at the exact moment when large money is already pulling out. Not by accident, but because this repeats itself like a closed loop. There are three main reasons why most traders fall into the same trap again and again. The first reason is reading the wrong signals. Most traders rely on indicators, RSI, MACD, things that look very logical. The problem is this: they only reflect what has already happened, while whales make decisions based on what is about to happen. When indicators start looking perfect, when everything feels textbook, it usually means the market has already moved a long way. Retail traders rush in, but what they don't realize is that they're stepping into a psychological trap built with great precision. The second reason is misunderstanding abnormal volume. They see volume spike while price moves up and assume it's real strength. But high volume doesn't come only from buying. It can also come from massive selling being absorbed quietly. Whales can distribute a huge amount of inventory without keeping price from falling, just so no one becomes suspicious. That's why high volume with flat price
is an extremely dangerous signal. Ironically, most traders see it as a promise. The third reason is FOMO. This is a deeply human instinct, and it's also what whales exploit best. When price moves too fast, retail traders stop analyzing. Only one thought remains: if I don't enter now, I'll miss it. But the exact moment you enter out of fear of missing out is often the moment large money begins exiting most aggressively. The truth is, retail traders don't lack knowledge. They're just looking at the wrong thing. They focus on the smokescreen built on the surface while ignoring the real footprints left underneath. And when you look at the wrong thing, your actions are almost guaranteed to be wrong as well. Now comes the most important part: 3 clear signs that large money is preparing to leave the market. These are signals professional traders need only see once to know what's about to happen. Signals no one wants you to notice, yet they can never be fully hidden. Begin.
Whales don't want price to rise too fast. If price explodes upward, the crowd starts to question it. And once doubt appears, liquidity slows down. So they keep price moving up very slowly, just enough to create hope, just enough for new buyers to keep stepping in. Before distributing, whales need only one thing: buyers. And the way they get them is by creating the feeling that the market is about to explode, while in reality, it's just a very thin disguise. When volume increases sharply, but price is held down, that is never random. Large buying volume without price moving higher has only one explanation. A massive selling force is quietly absorbing all incoming buy orders. If you look back at major market cycles in the past, you'll see this signal repeat again and again. When Bitcoin topped in previous cycles, volume surged, but price failed to break key resistance levels. Many stocks that rallied aggressively before collapsing all went through a final phase of huge volume candles, price barely moving, and long upper wicks, and right after that, a vertical drop. Even the gold market has repeatedly moved sideways at the top while volume expanded, signaling that large money had already begun to exit. So when you see volume rising sharply but price not advancing, that is not a buy signal. It's a very cold warning. Someone is selling at massive scale. Volume is the one thing large money can never fully hide, and just by recognizing this early, you can avoid many of the crashes most traders still call unexpected. The second sign: repeated false breakouts. One of the most sophisticated and effective tactics used by whales is creating consecutive false breakouts to draw in liquidity. On the surface, a breakout is always seen as a very positive signal, proof of a strong market. But the truth behind these breakouts is often the complete opposite. Watch carefully situations where price pushes above resistance, holds only briefly, then immediately reverses. Each breakout like this triggers a new wave of FOMO. Retail traders rush in, believing this is the beginning of a powerful move, and at that exact moment, large money is selling most aggressively. They need buyers to unload inventory, and there is no easier time to create buyers than right after a breakout. In the whale's mindset, the script is simple: break resistance, retail rushes in, sell to them. Price is pushed higher through artificial demand, liquidity sweeps, and the illusion that the market is very strong. But in reality, it's just a trap to gather enough liquidity for the exit. Crypto and stock markets have shown this pattern countless times. Many altcoins break highs 2 or 3 times in a row, pushing euphoria to extreme levels, and right when the crowd believes this time is different, the game ends. Many people believe this is the real rally,
But right after the final breakout, price collapses in one straight move, 30 to 50%, dragging all late buyers into a crash with no exit. When you look back at the chart afterwards, you'll notice a cold truth. Those breakouts were not genuine bullish signals. They were traps, carefully engineered. Here's the lesson. Whales don't distribute when price is falling. They distribute when you believe price is about to fly. They create false tops, not once, but repeatedly, because every time they do, another wave of FOMO jumps in to buy. And only after they've sold enough inventory does the market begin its real descent. Once you understand the nature of false breakouts, you stop getting pulled into them. You begin to clearly see large money exiting at the exact moment the crowd believes the trend has just been confirmed. That is the boundary between those led by the market and those capable of reading the whale's footprints. And now we come to the third sign. This is the stage where whales have almost completely exited, and the market needs only a small push to collapse violently. Once you understand this signal, you will no longer be surprised by sudden drops with no warning. The third sign, weakening momentum, drying volume. This is the phase where the market looks very strong, but is already weak from the inside. Price continues to make higher highs. The chart still looks clean. It feels like the trend has no problems at all. But if you observe closely, you'll see a different story. Each push higher comes with less force than the previous one. Price climbs, but momentum fails to keep up. Buying pressure no longer expands the way it used to. This tells you that whales have already exited the market. They don't need to sell aggressively anymore because most of their positions were distributed earlier at higher levels when the crowd was still euphoric and fully convinced of the uptrend. At this point, the market is left with only retail buyers trying to push price a little further. And the clearest sign of this is that volume begins to dry up. Price still ticks higher, but each rally requires less and less volume. Each pullback rally is weaker than the one before. Like a car climbing uphill with an almost empty fuel tank, it keeps moving forward, but only on its last remaining momentum. And when that momentum is gone, the market falls, fast, hard, with no time to react.
When the market enters this state, it becomes extremely fragile. All it takes is a small wave of selling, one modest distribution order, sometimes just mildly negative news. Price can fall like a waterfall, not because the news is severe, but because there is no volume left to support price. At this point, every upward move is nothing more than an illusion maintained by the very last group of retail buyers. If you look closely, you'll notice that many major market crashes appear right after a phase of weakening momentum and drying volume. That's when the market looks strong but is already hollow inside. The whale's footprints have disappeared, and when they're no longer behind the price, the market has no reason to stay standing. The conclusion of this signal is simple. When there is no volume supporting price, even light selling can send the market much lower than expected. Now we arrive at the most important part: how experienced traders read the market. This is how they spot all the signs we've discussed without complex analysis. One glance is enough to know whether they should stay out, and you can do this too. There is one signal that exists for only a few brief seconds, but if you catch it, you can avoid the most brutal distribution phases. What's striking is that more than 95% of traders never notice this signal. How many times have you seen a market glowing green, entered a trade, only to watch price collapse as if it never existed? It's not random.
Today, I'll show you why large money always knows exactly when to inject FOMO into the crowd. 3 early signals that warn of an upcoming distribution phase, and most importantly, the secret that professional traders need only a glance at to know something is about to happen. This is not an indicator, not an internet trick. This is the real behavior of large money. Understand it once correctly, and the market will stop hurting you the way it used to. Watch until the end, because I'll share one extremely simple principle that professionals use to avoid getting trapped when whales begin to distribute. This signal appears very quickly. If you're distracted, you'll miss it. Now let's answer the most important question. When are whales preparing to distribute, and why can professionals tell at a glance? More importantly, how do they act so they're not on the wrong side when price begins to fall? If the previous 3 parts helped you recognize the whale's footprints, this part helps you protect your account. The difference between those who lose money and those who survive is not about predicting direction. It's about how they respond when distribution signals appear. The first and most important principle: when distribution signs appear, do not open long positions, no matter how beautiful the rally looks, no matter how loud the crowd is shouting. The moment you see abnormal volume, long upper wicks, or repeated false breakouts, you must drop FOMO immediately. At this stage, you don't need to find entries. What you need is to protect your account and manage existing positions. If you're already long, don't wait for the market to confirm a downtrend before exiting. Professionals don't wait for price to fall before they move. Once they see clear distribution, they scale out gradually, never leaving themselves trapped by fragile hope. One powerful tactic, rarely used by retail traders, is tightening stop losses earlier than usual during uncertain market phases. It sounds counterintuitive, but it protects you from sudden dumps. When distribution appears, bring your stop loss closer to the nearest support. Don't let trades drift just because you hope for a bounce. Sometimes the best action is no action. Trading is often the art of not trading. When you see drying volume, weakening momentum, price moving sideways at the top, or abnormal trading speed, stay out. The market will always offer a clearer opportunity lower down. A final survival rule: never try to catch the bottom immediately after the first crash. After whales distribute, the market often falls in 2 waves, sometimes 3. The first move is a liquidity sweep. The next move is where the real trend reveals itself. Experienced traders don't compete to buy the first bounce. They let the market finish shaking out. They wait for a weak retracement. Only then do they consider entering. And once the market has clearly shifted into a downtrend, don't force a reason for price to rise again. The truth is, after the distribution phase, large money has already left the market. Price can only rise again when that money returns, not when retail traders hope it will. To enter safely, you need 3 conditions. First, the pullback comes with weak volume. Second, price structure forms a clear base, no longer getting slammed down the moment it tries to recover. Third, real buying pressure appears, not a temporary pump designed to lure people in. Only when all 3 conditions align do you have a smart entry. To exit safely, however, you need only one thing: seeing the whale's footprints. 1 sign is enough, not 2, not 3. Exit early, you survive. Hesitate, you pay the price. And this is also the most important message running through this entire video. To survive in the market, you don't need to be smarter than whales. You only need to avoid standing in front of them when they're distributing. If you're still listening at this point, it means something important has already happened. You've changed the way you see the market, no longer through emotion, but through clarity. And in trading, that is rarer than profit. We've just walked through signals that most traders have never truly seen. Breakouts that seemed harmless, long upper wicks like the market whispering a warning, volume surges where price barely moved. All of it comes together into a picture that only appears when you're willing to look deep enough. And now you've seen it. What makes a trader improve is not adding indicators, not adding news, not adding expectations. What makes them improve is the moment they stop chasing big wins and start listening to what the market is actually saying. From here on, strong rallies will no longer blind you with excitement, and sudden drops will no longer send you into panic. You'll begin to see the logic behind price behavior, and that is a true leap in trading mindset. Winning doesn't come from defeating whales. No one defeats them. What you do instead is move with their flow. No resistance, no prediction, just observation and stepping in rhythm. When you move in rhythm, the market becomes much lighter to navigate. If what you heard today opened a new perspective for you, hold on to it, because this is the foundation for long-term trading, not emotional gambling. And if you want to go further on this path, to understand more deeply how the market truly operates, stay with the channel. The next videos will take you into layers of understanding that very few are willing to share. Thank you for taking the time to listen, and thank you for taking your own finances seriously. May you always stay clear enough to recognize the whale's footprints and strong enough to never stand on the wrong side of the flow of money.